Today we're discussing US elections and what it means for our funds. With me, Kim Catechis, Head of Investment Strategy. So Kim, tell us the key points about what we should be aware about the US election.
Hi Zed, thanks for having me. So I think it's clear that this election is going to be different on a variety of levels. First of all, both sides are very energized, so we're expecting a high turnout, and that's a good thing. The one thing I think that characterizes this differently is the fact that there's a very partisan outlook on the pandemic, which is going to influence attendance at the election. So what do I mean by that? According to Pew Research studies, what looks like happening is that around about 80% of those who describe themselves as Republicans say they plan to turn up and vote on the day in person, versus 42% of those who describe themselves as Democratic. So as a result, we're expecting a very high number of early voting or voting by mail, which means that the result may take some time. And if we throw into the mix that both sides have got lawyers ready to take these things to the court, it could leave us with a bit of an uncertain outcome for quite some time.
And in terms of the likely scenarios that we should expect?
I guess the obvious thing to say, Zed, is that it's very important to win majorities in each house in order to be able to really push through on your policy platform. So what the markets appear to be focusing on is the three most likely outcomes. The first one will be a Biden sweep, in which case there's Democratic control of both houses. And I guess that would be good for the economy, and we'd get a lot of clarity because we have a lot of information already on what the intentions are. The second outcome could be a kind of policy gridlock caused by a Biden presidency but a Republican Senate, and that would clearly be the worst outcome. And then the third outcome that the market seems to fix on is a Trump presidency, but with a Congress that's controlled by Democrats. And what that does is it's not as good as a clean sweep. It's better than a gridlock, and I guess it's status quo. We know more or less what we're getting. How do you go about factoring these kind of things into your strategy?
So from our point of view on the funds positioning side, the areas of focus are infrastructure spend. Both candidates are going with pretty sizable infrastructure spending intentions to kickstart the economy and to get it out of the recessionary environment we're in at the moment. If you look at Biden's plan, it tends to be more front-end loaded, so it seems to be more supportive for economic activity. It is also more focused on green energy and decarbonizing of the economy. So from that point of view, it's important to assess a few aspects. From our point of view, we're well positioned in terms of beneficiaries of infrastructure spend in the industrial space, companies that will benefit from the increased construction spend. We're doing some work on beneficiaries of green energy initiatives, and that's something that could be potentially interesting as a long-term structural trend. And there are some interesting candidates that we're working on. On the flip side of that coin, of course, it will be negative for the energy space, the fossil fuel exposed names, the dirty utilities, so-called dirty utilities. We don't have any exposure to energy. We don't have any exposure to utilities. So from that point of view, we're comfortable with that. Then when you think about a few other initiatives, big tech will be a focal point, in particular for the Democrats if it's a clean sweep. And again, we don't have exposure to the big tech, the FANGs, generally across our portfolios. And it's something that we've been able to navigate quite well into markets despite not having that exposure. So that's where there could be some areas of uncertainty that the market will focus on. The other aspect of the Biden proposal is, of course, on healthcare, where the intentions are to widen Obamacare to a broader part of the population. This could be seen in two ways. One, potential negative for drug pricing and therefore for large cap pharma. We don't have any exposure to any of those pharmaceutical companies in the portfolio. On the other hand, we've got very high exposure to medical technology. And we think widening of the Obamacare to a larger part of the population will generally be positive for healthcare spending. And therefore, for the medical tech companies on the margin, it could be positive in terms of additional volume increases, and the companies that we're invested in don't have any exposure to pricing pressure. So we're comfortable from that point of view, and we're not looking to change our exposures there. And then finally, if you think about some of the Biden initiatives on tax, the intentions to increase corporate tax is one aspect. We've taken the prudent measure in our funds across all holdings, in so much that on our forecast, we have increased corporate tax across the board. And it's not just US companies, actually, it's across all global companies that we cover and that we're invested in. The reason for that is there's been infrastructure spending intentions across the globe to fight this pandemic crisis. And as a result, we think at some point in the future, there's going to be a need to fund this increased fiscal spending. And corporate tax will be one of the ways to do so. So having done so, it has impacted our fair value estimates across all the holdings, but not in a material way for us to make any changes. So all in all, we would say that that's the areas of focus. There are a few more detailed nuances that we are also considering, notably increase in minimum wages. But again, looking at our holdings, we haven't got any major exposure to companies that could be impacted by those higher minimum wage intentions that the Biden administration would put through. So the other aspect to also mention, of course, is the relationship with China. And it's something I'll turn the question back to you, Kim. But from our point of view on China, it looks like Biden and the Biden administration is not going to be any less focused on the China topic. But the Biden administration might be more diplomatic in the way they approach that. So in other words, that headline risk event might be lesser from us, for us as investors. But you've done quite a bit of work, Kim, on that. So give us your key points on that topic.
Yeah, thanks, Ed. I mean, I think you're absolutely right. No one should expect Washington and Beijing to suddenly, change their attitudes or their positioning. However, you're quite right to point out that a Biden administration would come with deep experience in foreign policy fields, and the economics part of the cabinet would probably not come with the same fixation on trade deficit. So what we would expect to see is a much more elegant way of dealing with the perceived Chinese threat. What I would also expect is certain tariffs might come off because it's clear that they're doing more damage to the American economy than perhaps the intention of keeping China at bay. I would expect maybe another trade deal might be signed. And more importantly, I think probably than either of these, I would expect Biden to spend some time, invest some political capital in renewing the US alliances that have withered on the vine a bit under the last 4 years. What that does is it's more powerful because it will enable creating coalitions to harness the most extreme kind of behaviors of China that are getting in the way at the moment.
It's certainly going to be an interesting focal point for the market. The other point we need to highlight, of course, for us as long-term investors is we're looking really at the 5 to 10 year time horizon. So hence the reason for us to focus on these long-term policy initiatives rather than that short-term volatility that the US elections might bring. So infrastructure spending and how it's going to impact potential opportunities for us as investors is one area. Thank you very much for listening. If you want more information, please visit our website. Kim, thank you very much for your input. It's been great to hear your thoughts as always.
Thank you, Zehrid.